In 2008, a retired schoolteacher in Ohio watched her life savings drop by 43% in 11 weeks. She had invested conservatively, she had diversified, she had done everything the financial advisors told her to do. And then, at the absolute bottom of the market, she sold everything. Within 18 months, the market had recovered completely, but she never got back in. She was too afraid. By the time she passed away in 2019, she had missed one of the greatest bull runs in American history, not because she lacked information, but because her brain betrayed her at the worst possible moment. This is not a story about bad luck. It is a story about psychology. And the 7 traps we are about to explore have cost ordinary investors more money than any recession, crash, or fraud in history. In 1979, Daniel Kahneman and Amos Tversky published Prospect Theory, a paper that would eventually win Kahneman the Nobel Prize. Their central finding was deceptively simple. Losing $100 feels approximately twice as painful as gaining $100 feels good. This asymmetry, loss aversion, is hardwired into your brain. It evolved to keep your ancestors alive in environments where a single loss could mean death. Losing your food supply was catastrophic. Gaining extra food was nice, but not critical. The problem is that your brain applies the same ancient logic to your brokerage account. When a stock drops 10%, the emotional pain is so intense that it triggers fight or flight responses. Cortisol floods your system. Your prefrontal cortex, the rational part of your brain, gets overridden by the amygdala, your fear center. During the COVID crash of March 2020, retail investors pulled over $300 billion out of equity funds in a single month. The market recovered within 5 months. Those who sold locked in their losses permanently. The takeaway, when you feel the overwhelming urge to sell during a downturn, recognize that feeling for what it is, a survival instinct misfiring in a modern context. Write your sell rules before the panic arrives, when your rational brain is still in charge. Humans are social animals. For hundreds of thousands of years, following the group was a survival strategy. If everyone was running in one direction, stopping to analyze the situation could get you killed. In financial markets, this instinct is catastrophic. Solomon Asch's famous conformity experiments in the 1950s showed that people will deny the evidence of their own eyes to agree with the group. In investing, this effect is amplified by uncertainty. When you do not know what a stock is worth, and honestly, most people do not, you look to others for guidance. If everyone is buying, it must be good. If everyone is selling, something must be wrong. The dot-com bubble of 2000 is the textbook case. Taxi drivers were giving stock tips. People were mortgaging homes to buy companies with no revenue. The herd was stampeding toward a cliff, and almost no one had the psychological independence to step aside. When Bitcoin hit $69,000 in November 2021, Google searches for how to buy Bitcoin reached an all-time high. When it crashed below $16,000 a year later, those same people were searching, is crypto dead? They bought at the peak of euphoria and sold at the peak of despair, because that is exactly what herds do. The takeaway, if an investment is making headlines and your neighbor is talking about it at a barbecue, the smart money has already moved on. The crowd tells you where the excitement is. It almost never tells you where the value is. Once you own a stock, something subtle happens in your brain. You start filtering information. Positive news about the company registers immediately. Negative news gets dismissed, rationalized, or simply ignored. This is confirmation bias, your brain's tendency to seek, interpret, and remember information that confirms your existing beliefs while discounting everything that contradicts them. A 2019 study published in the Journal of Financial Economics found that investors who owned a stock spent 67% more time reading positive analyst reports about that stock than negative ones. They were not evaluating the investment, they were defending it. During the collapse of companies like Enron and Wirecard, warning signs were visible for years. Analysts raised red flags. Short sellers published detailed reports. But investors who owned the stock found reasons to dismiss every single warning, until the stock went to zero. The takeaway, actively seek out the bear case for every investment you own. Subscribe to analysts who disagree with you. Read the short seller reports. The information that makes you uncomfortable is almost always the information you need most. You buy a stock at $50. It drops to $30. Instead of evaluating whether the stock is worth $30 on its own merits, your brain fixates on one thing. You are down $20 per share. So you hold. Or worse, you buy more. Not because the fundamentals have improved, but because selling would mean admitting the loss was real. This is the sunk cost fallacy. The money is already gone. It is irrelevant to the future decision. But your brain cannot let it go, because letting it go means accepting that a past decision was wrong, and your ego will fight that admission with everything it has. A behavioral finance study from the University of Chicago found that retail investors hold losing stocks an average of 24 days longer than winning stocks. They sell winners too early to lock in the pleasure of a gain and hold losers too long to avoid the pain of a realized loss. The legendary investor Peter Lynch called this pulling the flowers and watering the weeds. The takeaway: ask yourself one question about every position. If you had the cash instead of the stock today, would you buy it at its current price? If the answer is no, the only reason you are holding is psychology, not logic. After a few successful trades, something dangerous happens. You start to believe you have a gift, that you can see patterns others miss, that you are smarter than the market. You are not. A landmark study by Brad Barber and Terence O'Dean at UC Davis analyzed the trading records of over 60,000 households. They found that the most active traders, those most confident in their abilities, underperformed the market by an average of 6.5% per year. The more they traded, the worse they did. Overconfidence is especially dangerous because it feels like competence. The confident investor does more research, makes more trades, and takes more concentrated positions. Each of these behaviors feels like diligence, but the data is clear: the average individual investor would be better off doing almost nothing. During the 2021 meme stock frenzy, retail traders on social media platforms were posting screenshots of massive gains, convinced they had outsmarted institutional investors. Within months, most of those gains had evaporated. The confidence was real. The edge was not. The takeaway: track every trade you make for a full year. Compare your returns to a simple index fund. Let the data, not your feelings, tell you how good you really are. Your brain loves reference points. When you see a stock that was once $200 and is now trading at $80, something in your mind whispers, that is a bargain. It is 70% off, but stocks are not on sale. A stock trading at $80 is worth whatever the market says it is worth today, not whatever it was worth at some arbitrary point in the past. The old price is irrelevant. This is anchoring bias. Your brain latches on to the first number it encounters and uses it as a reference point for all future judgments, regardless of whether that number has any relevance. During the 2022 tech sell-off, investors poured money into stocks like Peloton and Zoom because they were trading at fractions of their pandemic highs. They were anchored to the peak price. Many of those stocks continued falling for months because the pandemic prices were the anomaly, not the correction. The takeaway: ignore what a stock used to cost. The only question that matters is what it is worth right now, based on its current fundamentals, current earnings, and current outlook. After a bull market, everyone believes stocks only go up. After a crash, everyone believes the sky is falling. Your brain gives disproportionate weight to recent events and assumes the immediate past will continue indefinitely. This is recency bias, and it is perhaps the most expensive of all 7 traps. A study by Dalbar, a financial research firm, found that over a 20-year period, the average equity investor earned 5.04% annually, while the S&P 500 returned 9.85%. The primary reason for the gap was not fees or bad stock picks. It was timing. Investors consistently bought after rallies and sold after declines, driven by the assumption that recent trends would continue. After the 2008 crash, investor surveys showed that the average expected return for stocks over the next decade was negative. In reality, the decade following 2008 produced some of the strongest returns in market history. The takeaway: when everyone around you is optimistic, raise your guard. When everyone is terrified, look for opportunity. The recent past is a terrible predictor of the future, but your brain will always insist otherwise. Here is the difficult truth that no financial guru will tell you. The biggest threat to your wealth is not inflation, or interest rates, or which stocks you pick. It is the organ sitting between your ears, running software that was designed for the savannah, not the stock market. You cannot eliminate these biases. They are part of being human. But you can learn to recognize them in real time. You can build systems that protect you from your own worst instincts. You can write rules when you are calm and follow them when you are not. The market does not care about your feelings, but your feelings will determine everything about your results. Learn the traps, name them when they appear, and understand that the greatest edge any investor can have is not information, it is self-awareness.